No, you'd buy the million because there's no degrees of broke. Like if you're broke, you're broke. In other words, if it works, it
Zero,
works.
zero.
0-0. So if you're walking away from a 250 or 500 million, but if it works, the million will give you the best return.
Land ahoy, mateys!
The archipelago awaits.
I think the higher level concept is asymmetrical risk to reward. Because I think you have some really good stories about how you've crafted investments. Like I remember you telling me the story in the financial crisis where, your stock portfolio was down, and then you've situated that bet where you were like, well, regardless, we're going to make money no matter what.
Yeah.
And the market's down.
Yeah.
Right. So the asymmetric opportunity there to be able to make money just was like a no-brainer, right?
Yeah. I got a question for you though. Yeah. You use the term bet. Why do you view it that way? Like a bet, like as in, like, because bet has a connotation. I'm sure it's all for most people listening. A bet is like I'm gambling. I'm making a bet. But how do you view it? Like, is it that way? It's not gambling. It's because I don't view any of these things as gambling. It's just but you use the term bet. I'm just curious.
Yeah, I've been using that term quite a bit lately, especially this last week and how I've been thinking about things. When I say the word bet, I think that it doesn't have a guaranteed outcome.
Right.
So I think that I'm placing this bet, right? And the bet is, it has that asymmetrical upside.
Yeah.
So when I'm placing the bet, like most likely, right, let's give it a 75%, 60% chance that it's going to work.
Right.
But of course, you always got the downside to it.
Yeah.
So then that's where I'm like, okay, well, let's place a bet and see how it plays off.
Because it's always interesting because, as you know, bet is always correlated to gambling. And a lot of times when people invest in the stock market, they think it's gambling, when in fact, all these things, especially because information, knowledge, experience in that, there's some you said an unknown outcome, but it's not like gambling, which is a known outcome. The house takes all the money. That's a known outcome. It's just most people that gamble don't know that or have forgot that fact. So so interesting.
Would it be like poker though? Because like poker, you have some agency and some control, and when you get the odds in your favor, then you place a bigger bet, right? Like
you place it. And so it is. It's just that correlation when people are talking about investing, like when I call investment, I don't care if it's in business, ourselves, whatever. And then bets are usually correlated to gambling, right? And maybe people say, well, because of the outcome, it's everything you do is a gamble, like But so it's just that there's an element or slice of the society that thinks betting and gambling, when in fact that's not really the connotation you're talking about. You're saying, you're basically a directional sort of.
It decision. Is more of a long-term investment, right? It's
right, 100%.
Making a decision that's a long-term investment.
Yeah.
But I guess like when I use bet, it's kind of fun too, because you don't necessarily know what's going to happen, but you want to see it play out.
Yeah.
And this is actually perfect segue into what happened like yesterday and over the weekend, because I've been using this terminology. We're at this point in the company right now where we have more opportunities than we can execute on, which is actually a great place to be, right? Especially where we were 3 months ago to where we are now, like happy about that. But now we kind of have to look around and say like, okay, well, what opportunity do we want to go after? And how are we going to make it happen? So then Nathan and I got together and we were talking about, and right now, like it's not a secret, like the wages in the company are under market, right? Like, and we've been completely transparent, right? Being in the startup company that we are, and the culture and the educational opportunities, it's like, this is what we pay. And really, ultimately, this is what the business can afford.
Yeah, absolutely.
Right? But then there's like multiple facets, right? So then part of it is, well, if we're playing people under market, right, and you're investing all that money back into the business and you're just running at break even, well, you don't really have the sustainable business, right? Because your economics are actually below what the actual operating cost of the business would be. So you're not true to the business in that sense. And we've talked about that in the past, being true to the business. And then the other sense is I also found it harder to ask and to hold people accountable, right? Because a lot of people in the company right now put in overtime on the weekends. They put in their extra time because they're excited about what we're doing and they want to contribute to the company. But I found it hard to ask people to do it because were under market, and because I don't want to put like all these expectations on them, so I found it hard to ask. So then what we're changing, so this is what I've been saying, the bet, the play, this is what we've been changing, is I'm having conversations with each person in the business right now, and I literally said, it's like, well, one thing that I think I'm bad at is being able to see when I'm right and investing more or placing a bigger bet. Usually, especially inside the stock market, so like a shop like stock like Spotify, say I'm up like 100% on it, and then it drops down and I'm up like 30%. I find there's hesitation in me to put more money into it, even though it's down, say 70% from the highs, but I'm still up 30%. It's harder for me to then put money back into Shopify, even though it's probably a really good investment opportunity, and it's already proven that I was right the one time. So it's almost harder. I don't know if you call that like a double down or like but you've used the analogy of like it's like spring-loaded.
Yeah, spring-loaded compression, yeah. What I call a true valued stock goes down the more the spring compresses and then springs up. But the only thing about that conviction, or that I'm, like you said, I'm hesitant to do it, I think it more surrounds like your clarity of what, like you said, I was right. I use your terminology that put in money and it went up. And I'm saying, like, in my brain, I'm like, you're right about what? Like, there's a difference between the market price and the value. So the fact that it goes up, I don't necessarily believe it's correlated to value, because there's a lot of things that go up that had no underlying value. And today people are buckets of money into whatever you call it, Bitcoin, you pick it. There's arguments that there's no underlying value in some of this stuff. So they can say, but you're wrong, because I put $1 in and now it's $2. And I'm like, okay, but I don't believe I am wrong. You're missing the price and value are two different things. So to your point is that when you put in money, it went up. That's great. And then you say it goes down. But the easiest one, I think, for myself that people can see and then we can leap is that, let's use something that we all would understand. In Canada, we have loonies. And that's easier to see it then. So if I said, okay, a loonie, which is $1 in Canada, if I said to you right now, there's a loonie and I'll sell it to you for 70 cents. Well, with the highest rate of conviction, forgetting all the government backing, all that is worth $1.
Absolutely.
So at 70, you saying that's a screaming deal, because I can sell it all day long for $1. Conversely, if I said, I'll give it to you for $1.30, you shake your head no, because it's only worth $1. So that clarity of conviction of those two, you would put more money in at 70 and none at 130. So as sure as you're sitting here. So then really what happens is, to your point, the difference between you and I and Warren Buffett is that he's very confident of that when he does the underlying analysis of it, that over time its value will show itself. And he has time. And maybe you could argue today at 93, 94, 95, 96, but the company the Berkshire still has it. So that's the difference. So sometimes I think what happens is the reason we don't go all in is because of our confidence and connectivity to its certainty. To your point, the dollar, my example of 70 and $1.30 are clear examples where you'd go all in and where you wouldn't, because as sure as you're sitting here the value. My contention always been is that most people don't really know the value. That's why they hesitate on the price. And sometimes even if let's say you bought a stock for $10 and it went to 11, and then you go, okay, I'm selling it because I made money. Okay, that makes sense because it went up. But you don't know if it's undervalued from 11 to $100 it should be worth, or if it really is worth $1 and at 10 you were overpaying, and now it's 11, it's just even more of an overpayment of that, right? So it's that correlation that I think, that clarity of what I call true conviction of the underlying value.
Yeah, I think that's a great point, because I think for myself, I think it's like I can value it and I can see the value inside of it, but I think the conviction part is what's harder for me, because I have had less experience, right? So I've made investments that I believe that have had good value and it's gone up, but I've seen over time that the patterns have repeated more. And so now I feel like I'm building more conviction inside of those investments or inside of those bets, where now I can say, when I see something like that, I can say, well, okay, this is actually an easier decision for me. I don't have to overthink it. I should probably put some more into it, right? I should buy that loonie at 70 cents. But what I've found is that, say you sold me the loonie at 70 cents. And I'm like, 100%, I'll buy that loonie. And then you come back to me and you say, okay, well, you know what? I'll sell you that again, but I'll sell it to you at 95 cents, right? So still that 5 cent upside on it. So really it's a no-brainer.
Yeah.
But what I found is that I have mental biases that have historically said, well, I got in at 70 cents. So why would I buy it at 95 cents? Because I've got in at 70 cents. So I'm overpaying compared to where I was.
Yeah, and then the interesting thing of that, then somebody runs away from the 95 because they go, well, I got it at 70, so 95 is not a deal. Then they go buy something for $1.30. So it's that comparison. It's that idea of that I got it in before, but that's a singular transaction, and 95 it's just whether it represents value to the dollar, if that makes sense.
Yeah, and that's what I'm starting to see through myself a little bit more. Is because in the past you use the analogy of, say, it's like a spring, and you push down and now that spring is loaded. Well, say that spring was loaded halfway. Well, the value on that stock is probably 70 cents, right? But say that spring is loaded up even more and now it's starting to shoot up. It's like, okay, well, now you have more conviction in that you were right the first time. It's like, well, now it's proven that the value is starting to get shown. Why not bet more or invest more at that time as its value is starting to show more generally to the public?
And I would say, and I know it's semantics, but I would say in that 70-cent loonie example, you would never use the term bet because there is no bet. You already know the outcome. And that's the difference when you talk to, I'm sure, Warren Buffett. Wish I could sit and talk to him. That, I know people pay $2, $3, $4, $5 million in charities to have lunch with him for an hour. That there is no bet in his mind. He's like, it's as sure as I'm sitting here. When I bought Coca-Cola and keep buying Coca-Cola, it's as certain as I'm sitting here. It's not a bet. It's a certainty. If I gave you the 70-cent loonie, it's not a bet. It's like, yeah, obviously, thank you. I'll take it all day.
So then what would you call when there is risk, though, right? Because I'm also like going to transition to this to like betting on people or investing in people.
Yeah, I'd say it's investing. I think it's investing. And what investing has that thing that the outcome is not, right? Even with people, it's not. Right? You don't know. Like you could invest in the people and all of a sudden they're going good and then they fall off the rails, or they go, hey, I'm moving over to Australia. Like, it's like, what? Where did that come from? But it's that investing in people, right? So where the bet in still my mind, it's a connotation of it's a gamble, right? If that makes sense, relative to cards, relative to, gambling. But these other ones, like I said, when you see that spring compress and you're certain of the value, then you put the money in. And that's why even like, I think Warren Buffett speaks about, like, he has two different things that are counter to what I call the standard market, just as an example. The first one is, diversity. Like everybody would say, you have to have a diverse basket. That's a very standard thing. Everything, asset allocation, diversity, that's a commonplace in Main Street, right? And I think Warren Buffett's view of that, diversity protects you from your own stupidity. So it's quite interesting that way. But he also has this thing that the 20 a punch card. You have 20 investments in your life. That's all you're allowed to do. So then you would be saying, wow, to your point, I could put one that's at 70, that loonie, I could buy it at 70, or that's going to be one punch in my card, and I only got 19 left, or I buy it at 95. Well, then you would say to yourself, well, 95 doesn't seem to be worth the punch card. I should wait and try to, find that 70-cent loonie, because then I'll punch it. And that's all he's done. He's saying if we had less of the ones we could do, then we would view them more. To your point, why would I buy it at 95? Not if I could have bought it at 70 or I did, but it's saying I don't want to waste that opportunity because the spread isn't anywhere near. So
then how do you handle it when it's I guess, when do you know that there's that conviction, right? Because I think it just ties to belief, and belief in yourself, and belief in the investment, and belief in the direction that you're going. But like tying it to, in a more like the stock market, I can run the financials on the stock market, right? Like I can go and value the company and say, here's the cash flows, here's the market, like here's the dividend yield. This is a smart investment. But if we move out of, say, like that strict, like logical valuation, and we move like transition to, say, like people, how do you then tell, say in that case, is it just kind of like the same valuation but in a different state? Like, I've seen their actions, I've seen their outcomes, I've seen the patterns of them, I know their mindset. Okay, based off of this, I have conviction, I'm going to invest in you.
Yeah, and I think that's a good point. It's because the other one, you have a set of metrics that you do, and I think with people you follow those metrics. But still, like, and we talk about it for all of us, is like we all look at ourselves 10 years ago, 20 years ago, in my case 30 years ago, and I'd argue that we can't recognize ourselves. So probably 20 years from now I wouldn't recognize myself today, and I don't mean physiologically or like just, but in terms of the way we mature, the way our experience goes, right? So sometimes some of this stuff, there is an unknown factor of that. But conviction is an interesting one, because if you're looking for what I call a confirmation from people, like, then, you're going, I wonder if I'm right. And you're asking, your opinion shopping for that. Well, opinions are like belly buttons. Everybody has one. So you're not going to get, I think it's just where you go through your metrics and say, all things being equal, this is where I want to invest. But even if there's no, in my mind, this is the difference between the stock. So stock, sometimes we pick an arbitrary point to prove we were right or wrong in that. So we bought it and it's up or it's down, and go, see, you're right, see, you're wrong. But if Warren Buffett did that, he would have went crazy. He just buys it and says, I'll just sit here for 50 years, and then after 50, come tell me. So it's all time. But with people, it's the same thing. We have our sort of idea, but I always view it as they're just moments of time that we're sharing our lives with these people, even in the business. And so the question is, how wrong are we? Like, meaning that if all of a sudden you went down and you picked the wrong person, and let's say everything that almost could go wrong with them did, I'd still believe that we would learn a ton. Mm-hmm. So then I really have a hard time understanding when people go, wow, doesn't that bother you? And I'm like, no, I learned a ton. And I don't think, now some stuff we learn about the behavior sets of people, maybe we'd be better off not learning, but nonetheless, I don't view it as a negative, because it moves the company from point A toward point B, then maybe it could have went faster, maybe it's a little slower, but all that experience. So I don't ever view as I can't think of somebody that I can sit here and say, boy, did that ever cost me by doing that. I would say, yeah, it's probably some lessons maybe I didn't want to learn or part of it, but they all moved us forward and everything continues to move forward. So, but conviction's a tough one, because it's like, where do you go, like, to validate it? Like,
there is no,
there isn't.
And you're taking on the risk, and you just have to go with it and trust yourself. So here's the change, here's the investment that we're making over these last couple of days. Sure. And I'm finishing it actually today here. So like I said, more opportunities than we can execute on.
Yep.
So we kind of have a choice. So we could run the business over the next 6 months to a year, and I think we would get us to a spot where we would be cash flowing well, and then being able to raise wages in the company to be able to play closer to market value. Or what we can do is we kind of make ourselves more uncomfortable, have conversations with the team members and say, hey, you know what? We have more opportunities than we can execute on today. What if we raised you to market value today, but then over these next 6 months, we're going to have to turn up the pace of the business. There's going to be more accountability. And in the past, haven't really ever asked anyone to work overtime, but like over this time, there's going to be an expectation that if we take on this challenge, like over these next 6 months, we have to buy in. And so the theory would be, in this case, is put the people first, and then the business will follow. So if you have conviction and you've seen those patterns in those people, right? And this is why I was asking you, well, how do you know, right? Because you don't really know, right? No. That's why I use bet too, is like, okay, well, we have to see how it plays out over time. And of course we'll learn, but then it's at that point, so you're putting the people first, and then I'm going to guess there's probably going to be a 4 to 6 months lag, right? So if we bump everyone up now, have more accountability, have good metrics, and be able to like expect more out of the person. And then in 6 months, I expect the business would also be able to follow and be able to get there as well.
Okay, so I have to ask you, just the things that go through my brain was, okay, so if you go to them and they say, so you're really saying to them, do you want to stay at this I'll translate it as if it's coming to me in my simple terms. Keep me at the same wage or pay me more, but you'll expect more.
That's right.
Okay. Now, what happens when you pay me more and I don't deliver on the expectation? Because human nature says that that's probably what will happen, right?
Yes, I think there has to be clear accountability and there has to kind of be clear metrics within that term, right? Like we have to have the transparency that this is where the business needs to be at.
Yep.
This is what is expected out of you.
Right.
And it has to be very transparent that these are the actions we need and this is the outcome that we're looking for.
Yeah, and so is there a world in between those two? Is there a world in between those where you're saying, look, here's what happened. You know where we are. So instead of us doing it this way, and instead of us raising it, why don't we go ahead and we'll go ahead and do it. And then when we get to the 6 months, you'll participate in the economics. So you'll deliver first. So the other one is company takes all the risk and hopes that these people get there. Second one is company doesn't take and says people don't. Or the third one is this blend where it goes, tell you what, let's do it. And then when we get the outcome, we'll share the outcome. Because now
yeah, it's because there's two different ways, right?
Yeah.
So yeah, because what I like about the first way is it's like you're betting on the person, but you're also saying I believe in you. You're also saying, hey, you know what? I've seen what you've done over the last year, this last year and a half. I know what you can do. I want to build this company with you. And we have a choice. If we buy in hard for these next 6 months, then we're able to put us in a different position.
Yeah, I think it's just, the thing is, it's the human nature side, because you'll see that either they'll all come along, which will be wonderful, and you'll get the outcome, or they won't come along and there'll be sort of a mixed outcome, which is very difficult, right? So inside of that, right, they'll either come along, mixed come along, or they won't, sort of, if that makes sense. So you'll be in that blend. So how do we do that balance between rewarding the people, so it almost prepaying them for the work they do, or not paying them and say the outcome of the end, or some kind of a blend. So yeah,
because I think in this case it's not necessarily prepaying. I think it's moving them closer to a level that I think they do deserve at this point. But the economics of the company necessarily isn't at the point where it needs to be able to pay that.
100%. So let me just ask you a question. So you go the 6 months, you pay them, and the outcome is a quarter or half of what you thought. Now what happens to the pay? So I'm sitting there, you paid me extra now, and I'm going to say extra, not relative to market, but to what I was used to.
Relative
so
to
now
today.
you've set the expectation. We're now at market, but the deliverables are less than that. So then now what do you surely can't move me back.
No, we have to adjust and we have to learn, right? And we have to keep moving forward. So yeah, there most likely wouldn't be a step back.
Right.
Yeah.
So when you say that, like, give me it sort of mechanically, like, I'm Johnny, you've paid me more, I've delivered half. The step back is what? Well, because I can't get paid less now because you've set the bar.
Yeah.
So that's the one thing about it. As soon as you set a bar up there, then people don't want to, never do they want to retrace. That's just human nature, and that's okay. So I'm not saying you should always underpay people. That's not what I'm saying either. But to your point of, is we want them to ebb and flow with the business. But in this particular case, what you're doing is you're sort of saying, this is where we're going to think will arrive. And you've set the thing to, so you've set the economics to say we are arriving. There's not a if. The economics say you are arriving. Whether you arrive or not, we'll see.
Yeah, the other part that I do like about it, though, like, I understand there's a ton of risk, but also inspiration or desperation.
Right.
That's the other part I like about it, is that it puts the stress onto it, puts the stress onto myself, and it says, hey, like, over these next 6 months, like, we're making it work. Because I don't think there's really been a thing that we haven't focused on. And I think this is the conviction part. There hasn't really been a thing that we haven't focused on that if we apply ourselves to, we can figure it out. And then if I look at those patterns and then I look at these people in the eyes and they say, like, yes, like, let's apply ourselves to this and let's figure it out. Like, I do believe that it makes myself and my business partner a little uncomfortable. It puts us more in the desperation mode. But then I also think it then forces us to be able to figure out the economics of the company faster. Or in this case, like you're saying, then we have to adjust the structure of the company. right? If we don't figure it out and say that, say we invested in that person and then it shows over time that they can't be able to get to the point where like we believe they could get to, well, then they're probably not in the company, and you probably have to find someone that can be able to get to that point, or they have to take a step back, and they have to be fine with that. Like, it does set it up for that situation where if you're setting that bar, it's like, we have to be at this bar now, or else really it's unacceptable, and that's where we're holding it accountable.
Yeah, I'd say just the 2 cautionary notes would be, don't make sure you're not confusing when you say the statement, we've never, like when we set something out, we always accomplish it. Is that you or the company? Question mark. Because those are 2 different. If you say that's just the nature, you're like me. It's like if you say we're going to go over to that, walk to that building, I don't care what it happens, I will walk to that building. I don't care what happens, I don't care the weather, I don't care if there's cars and like, it's just that I'm singular folk, but that doesn't mean that everybody else is. So so just balancing that, and just the balancing that, you know, as you call it, the bet, the investment is, can you stage it? Can you say we will go halfway for 3 months and then the other half the other one? Like, it just gives a sort of a just in case kind of idea. So in other words, I'm not saying not to believe in your conviction. I have no problem. Like, believe in your conviction, right? But it's not your conviction, it's everybody else's conviction that I'm concerned about, not yours.
That's right.
Right?
Yeah.
So when Warren Buffett does it, he's doing it for, like, at that time, for himself. And it's his conviction. But, right, if he said, well, down the line, I have to bet on everybody else's conviction. Well, most people aren't wired that way. So, yeah, so I think, no, but I like it. I like the idea.
Well, it's exciting. And then over these next 6 months, like, that's what I'm super excited for, is like, I've just had a lot of energy. And I think it does tie to conviction, right? Because you know me. So then when I say, okay, I'm going to set out and do something, well, I'm going to do it.
No, don't.
And then I think it's also betting on my conviction on me understanding who's inside of the company, right? And then placing those bets or those investments, because then that is my conviction on the value that I see in them.
Yeah.
And then to me, in a lot of cases, a couple of these are like, honestly, kind of a no-brainer.
Yeah.
So then in my mind, then it's like, well, then it is more risk. And then, to be honest, it adds like more of that unknown and excitement to be able to say, like, this is what we're going after.
Yeah.
And we're hopping on the boat, and we're cutting the tie line, and we're going, and we're going to figure it out.
And again, you're going to live this thing and see where it comes, and you'll live the people side of it. And I suspect that you'll have a mixed bag is what you'll have, like you should always have. Because again, you don't know where the Peter principle, you know, where people are hitting their ceiling and you've seen good things from them, but that might be all that they have to give, or it might be, and that's what we're hoping and saying, and not hoping, hope's not a strategy. So is that no, look, they're going to shoot through that ceiling, Daryl. They're going to go, and I'm saying, yeah, then go on that journey and see. Just always balancing that you don't have to put buckets of risk on, especially if you could stage it or do any kind of combination. It still has the same effect, but might give a little bit more breathing room for the company, right? And as well as if you go halfway with it, the other thing to consider is then you would see if they even are rising to the half. Because if you go all the way, then really what you've also done, to your point, you've said, you've almost, I'd hate to say it, you almost ultimated them in the sense that if they don't rise, they can't be there.
Yeah,
So,
that would be the downside of this.
So I think it's just a question mark staged, question mark balance of risk. Yeah, just go on the journey, see where it takes you.
Yeah, absolutely. Absolutely. And I think that's a part of it too. Because we talked about the asymmetrical risk to reward and making like smart business decisions. Is that I do think, like, I think your mind is amazing at that, right? Being able to say, give the upside, give the incentive, bet on the person, but then also be able to stage it out to be able to say, you know what, now you're balancing the risk out for the company. And in that case, well, then you're making a good decision for the company and a good decision for the person.
100%.
And essentially you're getting the same outcome, right? But just with less risk.
100%. And
I think that's what's really important about that bigger concept of asymmetrical risk to reward, is that you're looking at the situation, whatever it is, right? I proposed you mine, But then you're saying, how do I deconstruct this to put me into a place where I have less risk and more upside, and then be able to take advantage of that upside and be able to follow through on it?
So everybody that's ever been a part of the stock market, invested in the stock market, had clients in the stock market, then everything's about, the market goes up, the market goes down. And really over time, there's some really pronounced times where the market corrected itself. The crash of 1929, the 87 crash, right? There was a crash in 90, and there was a crash in 2000, 2002, and then 07 to 08. There's some big crashes, and some of these were 50% declines in the market, right? So what happened was in that 07, 08, there was two things that were happening. Is that obviously we've seen lots of shows after the fact about the subprime and the mortgage crisis, but the market corrected itself down. But in the meantime, it had went down 50%, which would make it one of the deepest drops that we've ever seen. And so, but simultaneously, most people didn't catch that the interest rates had dropped 70%. And so so that convergence of those two things hadn't happened since 1932. So I'm going to call it like Halley's Comet. It was like 78 years, and when those convergence, so what that meant was in sort of practical terms is that you could buy that compressed spring at dirt cheap if you believed that the companies were going to come back in value, which they always do, and especially good quality companies. And then if you had to access money, you had the cheapest money on record ever to do it. So in other words, if you were going to go buy that compressed spring, you could access money to buy it now the cheapest and deductible. And so this money was costing, 2%, 2.5% deductible, which means 1.5 net. So you could pick up money. So imagine somebody giving you a big basket of money for next to nothing and saying, buy the compressed spring. We hadn't seen that convergence. Like I said, if you ran the convergence, and then if you looked a year or two out after any of the market declines, the market springs back. So it was that, could you see that? Now, what was interesting about that, even for the advisors, they had a hard time getting their head around that. So what they said is, to your point, what if? What if you make that bet, if you want to use the term, and it doesn't come back? But what they didn't understand is, what does it mean if it doesn't come back? It meant that every investment that you already had is worthless. So imagine you had a $500,000 portfolio in a balanced portfolio, and now this thing came plummeting down. And so people were going, well, that bet, I don't know if you should, borrow some money and to invest it like that. But then practically what they were saying, that it was either the stuff that they all had, that everybody across Canada, North America, the world had, was going to be worthless, or it would come back. So to me, it seemed over extreme that every single, like if we're going to our Tim Hortons for the morning coffee, that what actually happened to Tim Hortons that would cause it to be down 20, 30, 40%? The lineups weren't any shorter. People were still buying coffee.
Yeah, the underlying value was the
The
same.
underlying value is the same, and even was more compressed, right? Because so then you sit there and say, these companies, the day before were running good, long lineups. The day after they have long lineups with some arbitrary pricing mechanism said they were worth 30 or 40% less. Not based on any metrics, but just a fear, irrational fear of people. So the reality, that was, if you wanted to call it a bet, but one of it had a highest degree of certainty when you looked at it and said, there's no way on earth it's not coming back, because it's populated by everything that we're talking about. These big companies, like people are buying Coca-Cola still, doing it. So the reality is, when we isolated and looked over here and said, wow, that seems like quite a bet. When you looked at it, you're saying, no, it's actually kind of ridiculously. So by putting those, but in the meantime, you had to sort of put away behaviors that you had to put away hysteria of everybody's being hysterical. What's going on? The earth is come down, the world's come down.
That's what I was going to say. You have to quiet your emotions and not listen to anything but your own conviction in that moment.
100%.
Because if you open up the media or you start asking about everyone's belly buttons or opinions, it's going to be like,
100%.
Get out.
Right. And I remember during that time, it was quite interesting. There was two big prominent ones because of the US and Warren Buffett, but there was two companies, Goldman Sachs, and GE had went to Warren Buffett. And at that time, they needed some cash, because everybody was sort of collapsing. So Warren Buffett lent them $10 billion at 10% each. But so then you say, well, okay, that's what's so fabulous about that return. But he also got options into their company at certain prices. And as it turned out, and they within a half year, 3/4 year, they had paid all that money back, but he got those options. And I remember an article that came in there, and he had an option in Goldman Sachs, and I do believe the option was for $110 a share US. And at that time, the shares were like $60, $70, $80. And some editor that has the wisdom compared to Warren Buffett said, look at this old guy, doesn't, he's obsolete, doesn't know what the hell he's doing. Look at you got options at 110, it's 80. Well, I think today I haven't looked, but it's $400 or $500. So if we were doing bets and saying, let's take a survey of everybody who won the bet, everybody would have bet on that news reporter.
At that moment in time.
At that moment.
Mm-hmm.
But Warren Buffett doesn't care about that news reporter, in his opinion. He just knows the underlying values of these institutional companies. Not too big to fail, but big companies that had a lot of assets under them that would support that. And all of a sudden, so the amount of money he earned during that window by just having cash and being able to see that. But you have to sift through that. But if you go, you asked me, like, how do you know to make the concentration, or to say conviction? Well, there is a funny thing that investing, they call it, and most people don't know this, but it's called an odd lot theory. An odd lot theory is just a thing that says this: if they follow it and follow these people selling odd lots are usually small investors. So, if you're a big investor, you don't buy 163 shares of GE, you buy 10,000. So the odd lots are the little investors. So what happens is if they follow and track it, the theory is that when you see a whole bunch of them being sold, it's a time to buy.
Yeah, do the opposite.
Do the opposite, right? Right. And we joked about this with your friend on the Manu shares or whatever in the past.
Mm-hmm.
But it's that idea that most people are wrong. So really, at the end of the day, if you went and said, look, this is what I'm going to do in the bottom of 08, in March of 08, I'm going to take the cheapest money that's been historically in 100 years, and I'm going to take a block of it, and I'm just going to buy a cross-section of these big companies, these US companies. And if I went and asked for an opinion of 100 people at that time, random people, what would you guess that they would have told me?
Oh, that you're crazy.
That's why you need to do it.
Well, I think what's so cool about that too is it's not only saying buy in the compressed spring, but it's also saying it's like, how much capital am I risking? And that's really another asymmetrical bet by itself. It's
right.
Like, I'm not even risking much of my own capital. I'm going and borrowing cheap money, and I'm risking that money on a bet that I believe is pretty much certain.
Right. And so when in the States there, during that whole time, there was a lot of people couldn't figure out there's these ninja mortgages, which is no income, no job. And so I want you to think about just the average person if you went up during that window. So really what that meant was they didn't care if you worked or not. They'd lend you any amount of money to buy a house. So there you are, you're about to buy a house. You have no money, you have no job, you probably have no prospect of a job. But you think in your mind that all you do is make money on houses. Okay? And in the US is different than Canada. You can just walk away from the mortgage. So it's interesting. So then the premise would be, and this was something I've always asked people is, okay, so there you go. You can buy a $250,000 house, $500,000, or $1 million. Remember, you have no income, no job. So which do you buy? And most people would answer when they quickly ask, they would say, well, I'll buy the $250,000 because they're viewing it from a risk perspective. And I'm like, no, you'd buy the $1 million because there's no degrees of broke. Like if you're broke, you're broke. In other words, if it works, it works.
0, 0.
0, 0. So if you're walking away from a 250 or 500 million, but if it works, the $1 million will give you the best return.
Well, yeah, because if they all double, right?
Right.
250,000 goes to 500,000.
Right.
Great, you made 250,000.
Right.
$1 million goes to 2 million. You just made $1 million.
Right. So there is, like I said, no degrees of broke. It's either going to work or it isn't going to work. But if you have no income, no job, what's it going to be? It's going to be like, what's the downside? So they couldn't understand that, why these people were loading up on these things. Well, it's like, well, of course you gave it, like, no, they should never have done it. And as it turns out, the people that were lending the money and the brokers, the mortgage brokers were getting paid an arm and a leg, and it was just ridiculous. But it's just the human nature that says, look, if there's no downside, like right now, if I said, and I remember one time I never told you this story, but I was sitting at like one time we went to a casino. I'm talking, I was probably 20 years old. Walked into the casino and gonna play, I got $20 or $50 to play some 21. Well, there happened to be this guy that was a kind of quite a wealthy guy in Southern Alberta, but was a total raving lunatic. I'm like way the hell out there. And I stood walked over to the table, standing beside him, and he wanted to play the whole table. And they didn't, because he was this crazy guy, they didn't want him playing. So they said, no, you can't play if you're by yourself. Then he turned to me, and I don't know this guy, and he goes, hey, do you want to play here? And I'm like, I got $20. He goes, here's the deal. I'll give you the money. You bet. If you win, you keep it. If you lose, I'll take the losses. Okay, great. So I sat there. Think about that. So he's going, how much you betting? I'm going, 100. At first, I'm like a little hesitant, right? And then I lose, and he looks at me and he goes, here's another. So then I win, and I get to keep the 100. And I'm like, how much you betting? And still didn't get it. Like I should have said 50,000, but instead I'm like 100. So anyways, for 5 seconds, I won $300-400 more than I ever would have with my $20. But really, he took away all the downside, and because he wanted to be crazy and do his thing, and that's fine. But it's very interesting. So when you sit and think about that, when you're asking people to make a bet and they have nothing to lose, then they tend to go for it all, because what's the difference? And that's right. So,
well, I think we also play up that we have more to lose than what we actually do, right? Because even I know you've said in the past, it's like, well, say if you just lost everything today, right? Like, what would you do? It's like, well, how much conviction do you have in yourself that you'd be able to build it back, or be able to get back to the point that you were with all the knowledge that you have?
Right.
Or that we're scared to be able to take risk. And even if it puts us in a slightly uncomfortable spot for like the next 6 months, we downside like what that can do for the next 20 years, right?
100%.
Because if I buy the $1 million house and I sit on it for the 6 months, and I'm scared it's going to go down, I could go broke. Yeah. But then what's the upside for the next 20 years?
Exactly. Yeah, so it's that balancing of that, and we can't get out of our own way in this sense. So when the opportunity, like always people go, well, I never had an opportunity, or, well, they always downplay it, but the opportunity does arrive, and it's walking by us every day, is whether we can see it or not. But when it does come, what do we do with it? What do we do with that opportunity? So the point is that if I was sitting at that table with that guy, and he said, I'll cover all your losses, and I go, okay, I'll bet $10. When I could have bet 100, so why wasn't I saying 100, 200? Why wasn't I matching whatever he was doing? Because he covered me. It's just, you're not used to it. It's like, well, no, like what? Well, there's got to be a catch, and we convince ourselves. And in this particular case, it wasn't. The guy was a raging lunatic, but otherwise, like, there's sometimes the opportunity. It's not to suggest, though. I want to be very clear in my mind. It's not like somebody tells you to bet on Bitcoin. Like, that's not what I'm talking about here. I'm talking, there are some things that sometimes become. There's
fundamental principles that you can learn and follow that tell you what good investments are, right?
Yeah.
Like, one of them is that, like, the best time to buy is when other people are forced to sell, right?
Exactly.
Like, if you're getting margin called and you want to bet in this more, but you can't actually put any more cash,
right,
you're forced to sell at basically the worst price.
Right.
And if you see that happening around you, and you see the valuation of the companies, and you're 100%. Like, I believe in this,
right,
that's a great opportunity to buy.
100%, right? And it's not that you want to see the misery of somebody else, but that, truthfully, is what happens, is that, whether it's foreclosures, whether it's saying, sometimes it just happens to do it, like, right? So,
and what the other interesting part is, like, the stock markets, the odd lots, like you're talking about, it's like, it's almost like the psychology of the masses.
That's it.
Right? It's like, you could probably, it would be really interesting to actually say, take a line chart, a histogram of the negative news articles, and then correlate that with the stock market, the odd lots, to see, like, the increase in, like, negative connotation in the media versus, like, buying or selling of the odd lots, to see, like, how much the media influences the mass.
Actually, it doesn't have to be in odd lots. In the Time magazine, they did a correlation between Time magazine covers, and when the market is going down and people are panicking, then they pile on. And I actually, at one point in the office, in the financial office, I put up all the Time covers. And really what it showed is every time that they said the sky is falling, that was the best time to buy. It was because we can't get out of our own way and we buy into the mass hysteria. And the other final part of that is it's just our time. So to your point of like Warren Buffett buying something, he buys something. In that moment of time, like Goldman Sachs, in that moment of time, somebody could have said he was wrong. But if he just steps back and lets time unfold, and then he looked at it, the punch cards that he's bought have always, because they're fundamentally good things. So if we buy something fundamentally, just get the hell out of the way, then we see the thing. But again, if we put short time frames,
I think you're really getting rewarded for going against human nature.
Yeah,
because
contrarian.
like if I think of the thing that came to my mind is, say I'm out in the woods, right? And I hear a bear roar.
Yeah.
I think I heard it. I don't know if I heard it. I don't care. I'm going to run, right? Like
Right.
I'm just going to get out of there.
Right.
But now what we're saying is like human nature is telling us to run. Like the stock market's
Yeah.
down, the bear has roared, right? It's like, I'm getting the heck out of there. But what's the upside if I'm in the woods? So if I'm right, well, the bear's there and he's probably going to eat me. So that's terrible.
Yeah.
But if I'm wrong, it's like, well, great. I'm still in the same spot where I used to be. But in this case, it's like, no, going against human nature is like actually being able to see the long-term value in what you're doing and going against what your instincts tell you. Because I've been there. Like I've been like on Palantir. Like Palantir has been a wild ride these last 2 years. At the top, I was like, I got to a point where I was like, holy smokes, this thing's worth a lot of money. This has to be the top. And then it went up. And then I was like, holy smoke. So then I started selling, but I sold as it kept going up, but it felt wrong, right? It felt like you were losing going up.
Yeah.
But then now it's at this point where it just dropped 50%. And I'm like, well, now I'm happy I sold.
Yeah.
But then it's like, well, now I'm looking at it and saying, well, should I sell more? I feel like I should sell more. But really, this should be the time where if I believe in it, I should buy more.
Yeah. That's the opposite of what we always do, right?
Yeah.
And we tend to do the opposite, right? And so more than anything, that Warren Buffett, he just sits back and says, this is, I've done it. I've done the research. I've done the conviction. I'm going to stay the course. I'm going to have time. But he's not there trying to prove it to anybody. That's the difference too. So like, I think sometimes even in, sometimes when you're saying to yourself, should I buy more? It's the comparison. I could have bought it. I bought it at 70. Now I can't buy it at 95, not because it's not a deal at 95, but because I should have bought more at 70.
Yeah.
So it's almost like I'm going to punish myself more, or it went up and I sold it all the way up. And you're sitting there on the table with profit. That's not a problem, except for, oh shit, I shouldn't have sold. I should have waited and sold it. Like it's the things we do to ourselves versus saying, just look at it like independently as we sit, right? But again, like when it goes up or drops or goes up or down, and I don't know the stock that you're talking about, but if you know the value, then if you really know the value, then its movement in price means absolutely nothing, right? It's just like I think the easiest way for people to see that, if they sat there with their home, and if they sat there, and let's just say for the sake of arguing, that every day you were sent a message that told you the value of your home, every day. So if you bought a house and it was 400 grand, they go, it's 401. And then all of a sudden one day it was 396. You go, what, it was 401? I better sell. Like, just think of where everybody would be their home instead of just relaxing and saying, when I bought it for 400, 30 years from now, it's going to be worth 600, 700, whatever the number is. Okay. That kind of idea, $1 million, whatever it is. But it's because that information comes and we think we have to do something. And usually if we just stop doing something, sat still, to that old Buddhist sort of thing that, I want to conquer the world. Okay, well, I'm going to go meditate. Well, what do you mean? That's not conquering the world. Yeah, it is, because it's relaxing and coming up with the game plan.
Yeah, it's about seeing through the fog.
Yeah.
I think that's the big part. If you can see through the fog, you can identify the noise and you're able, just like we're saying, just wait. You're sitting on a good asymmetrical opportunity. Sit there, wait, and just let it play out.
100%.
Yeah.
Whether it's investments, whether it's business, it's the same. It's the same with business. It's like people go, well, how do you stay the course on it? Well, the answer is it's either the model is right, and if the model is right, time will prove that. And
especially starting the startup company. That was something I really had to learn, is like, I could sit here and I could look at the financial projections of this company and I could look at that every day and like adjust it, but then I would go crazy.
Yeah.
I would go crazy and then I would play out all these scenarios that could happen or couldn't happen, or I could just take it a month at a time. and say, this is where we are. And even if I look back 3 months now, it's like, holy smokes, we're in a different position, right?
Yeah.
But if I was in 3 months ago trying to project the next year, it's like, honestly, I'm just wasting my time, and I'm doing, I'm doing the business a disservice.
Absolutely. Yourself and the business a disservice. The fact is, if you look at the model says right, and we just got to stay the course, and we added time and just effort to this, then I believe the reward should be. Now, if the model is flawed, or the business model, like I said, there's some businesses you can spend your whole life doing and it's never going to make a penny. It's just the type of business. But if you have the right model and the right people over time, you just got to get the hell out of the way. It is hard to do because we think we have to do something versus saying, no, it's right on track. Just let's go, right? And investors can't stay the course on whether it's businesses, whether it's shares, everything. We've talked about that historically, that even if they could go back in time, they would never own it today because they just get in their own way. It's the same idea. So it's just having that when the opportunity comes and you do understand it, then you don't go to the world and ask their opinion. You just take the step, and I think the outcome will be what it should be.
Hear, hear.
Hear, hear.
Anchors up!
Time to set sail.